Okay, in this video we're going to take a big picture look at the cost of capital and see some of the important ideas behind it. First off, let me apologize for my voice. I got a bit of laryngitis as I sit down to record this, so hopefully you can fight your way through it just as I am fighting my way through it and still make sense of everything you hear today. So in the next couple of videos we're going to be looking more closely at the computational aspect of the cost of capital, and we'll show how to come up with the appropriate numbers. But in this one thing to keep in mind as we look at the cost of capital for a firm, there is probably at least as much art as there is science involved in any calculations we'll do. So it's another way of saying that there is some subjectivity involved here, and there is rarely only one right answer. So keep a little bit of flexibility about yourself as you consider these things and use them in problems. The important thing to keep in mind is the general principles and to apply those as best you can. So why does the cost of capital matter? Well, first it's important to keep in mind the relationship between risk and return. This is a fundamental idea in finance, that the expected return of assets is a function of the risk associated with those assets. The more risk associated with any investment, the higher return you'll expect. The cost of capital provides us with an indication of how the market perceives the risk of our firm. That is, the risk of our particular collection of assets. Our cost of capital will be higher than other firms if the market believes that we are in a relatively more risky business, and it will be lower if the market believes that the risks we're facing are relatively lower. We also care about the cost of capital because it helps us determine the required rate of return for our capital budgeting projects. We want a return for our investments that is at least equal to the cost that investors are going to be charging for providing those funds. So let's look at required returns and how they relate to investment decisions. As I mentioned before, the expected return of assets is a function of the risk associated with those assets. The more risk associated with your investment, the higher return you expect from that investment. So we use the required return to evaluate capital budgeting projects. Anytime we are making an investment decision as a firm, we look at the expected cash flows from that investment, and then we evaluate those cash flows using the discount rate to see if the NPV is greater than 0. Another way of saying that a project has an NPV greater than 0 is that by investing in a project, we're going to earn a rate of return that is at least enough to pay our investors for the funds that they are giving to us. So we're paying the bondholders the returns that they expect, and we're providing the equity holders with the returns that they expect. When we start using the weighted average cost of capital, we need to keep in mind a few things. The number we come up with is not a one-size-fits-all weighted average cost of capital. We don't blindly apply that to everything you're considering for a firm. We need to evaluate the projects of the firm based on the risks associated with those projects. So we might come up with a WACC for a firm, but we need to adjust the WACC to take into account the particular nature of a project that we're considering. If the project is riskier than average, it should have a higher expected return, and we should be using a higher WACC in evaluating that project. This leads to the important notion that the WACC we calculate for a firm is an average cost of capital for the firm. If we look at the expected return for all the individual investments of the firm, and then we average them, we would have the WACC. Another way of saying that is that the WACC is the expected return for the average project of a firm, with an average level of risk. If we're considering a project that has different risk characteristics than the average project, we need to and must adjust the cost of capital. So one manifestation of this idea is that different divisions of a firm may have different WACCs. To the extent that the risks associated with each of the division's investments are different, we need to evaluate their investment projects with different discount rates. We don't want a high-risk division looking at a project and using the firm's average cost of capital, because at that point we have a big disconnect between the risk of the investment they're considering and the required rate of return for the investment. That's the same thing as saying that we want the discount rate to be appropriate for the individual project that we're evaluating. If the project we're considering is a big departure from our normal business, we should not use our normal cost of capital, our normal WACC. What we need to do is find a more suitable required return that is more closely associated with the risks of this particular investment. So in this case, we might look for a proxy. We might look for a firm that has similar risks to the project that we're considering, and that's called a pure play firm. So it's a firm that invests solely in that kind of business, and we can look at it and see the risks associated with it and look at the required returns for investors in that firm. So as a segue to the next set of videos, let's get a big picture look at computing the cost of capital. The first thing to keep in mind is that the expected returns are always a function of risk. The higher the risk, the higher the expected return. And this is true of all investments, whether you're a firm investing in a project, or you're an investor buying shares in a firm, or you're a bank making a loan. You expect to be compensated for the risk that you're taking by providing money to the firm. As we consider the risks that a firm's investors are taking, we need to remember that the firm's debt holders, that is the banks or the bondholders of the firm, are in the safest position of all capital providers. The firm's lenders have the first claim on the assets of the firm, so they're first in line if something goes wrong at the window to get money, and they're going to get theirs before anybody else gets the money that they're expecting. So an outcome of this is that because they take the least risk, they also expect their returns to be smaller than the returns for other investors, in particular the equity investors. Equity investors, on the other hand, get the leftovers. They are the residual claimants on the firm's assets. They're at the back of the line if anything goes wrong in terms of waiting for their money. So as a result, they're in a riskier position than lenders, and so they're going to require a higher rate of return to compensate them for their higher risk. So in the next couple of videos, we're going to take a look at putting together all of this, and we're going to come up with the weighted average cost of capital for a project so that we can evaluate the NPV and we can make decisions on a firm's investments. One quick caveat as you look at the next couple of videos in calculating the weighted average cost of capital. The videos both mention flotation costs, and they go through calculations to adjust for the fact that whenever a firm raises money, that incurs costs. There are fees associated with getting a loan from a bank or selling bonds or selling new equity. I don't want you to get bogged down in the details of those flotation cost calculations. You can ignore that if you want to. It's kind of there for your information. But for our purposes, you're safe to kind of skip over the notion of flotation costs, especially if that starts to add too much difficulty and it distracts you from the bigger idea. So that's the end of this video, and we'll have two more to look at calculating the weighted average cost of capital.